Just because a large portion of the city will be in the Cotswolds for the Cheltenham Festival doesn't mean the rest of us can nod off. After last week's budget, the central bankers will take centre stage from politicians in the week ahead. Bank of England Governor Mark Carney will introduce the latest interest rate decision on Thursday the 16th, the same day as we get a policy announcement from the Bank of Japan. That's also just one day after the US Federal Reserve is widely expected to push through a 1/4 point hike in headline American borrowing costs to 1%. That will be the third increase of this upcycle, the others having come in December 2015 and December 2016. Maybe, just maybe, the Fed is starting to move at a less glacial pace, and this is important. Normally, interest rate increases, better returns on cash and higher bond yields make it harder, though not impossible, for stock markets to advance. Though for the moment, investors are buying shares, taking prices higher, in the view the Fed may be moving because the US economy is strengthening and that in turn could be good for corporate profits. Now, as if such big macro issues weren't enough, 3 FTSE 100 firms and a bag full of FTSE 250 names are due to report numbers in the week ahead. They include miner Antofagasta, online grocer Ocado and giant life insurer Prudential on Tuesday the 14th, gold miner Polymetal and recruitment consultant Robert Walters on Wednesday the 15th, and construction support services specialist Balfour Beatty on Thursday the 16th. But for me, the stock really capable of causing a fuss in the week ahead is grocer Sainsbury, which is due to unveil a fourth quarter trading statement on Thursday the 16th of March. The third quarter statement back in January read pretty well, showing a return to like-for-like sales growth at the core supermarket business, albeit of just 0.1% excluding fuel, and 4% like-for-like growth at the newly acquired Argos operation, numbers which start to vindicate boss Mike Coop's 2016 swoop for the catalogue retail business. This chart shows the like-for-like progression at the grocery business in sales. Now, the like-for-like sales figures will be the key headlines from this update, both from grocery and Argos, but you'll also need to dig into the detail. At the third quarter stage, Sainsbury flagged strong online and convenience sales, up 9% and 6% respectively, both key points of differentiation from Morrisons, for example. While to the chagrin of shareholders in Next and Marks and Spencer, Sainsbury's joined Morrisons in flagging strong clothing sales. So, keep an eye out for comments here too. It's unlikely that Chief Executive Mike Coop will talk about profits at Sainsbury's, but if he does, the analyst consensus is for pre-tax profit of £575 million against £548 a year ago, with a total dividend of 10.3p, down from 12.1. However, those details are only likely to come out with the full year results, which normally come out in early May. Now, as we can see here, Sainsbury's has actually had a pretty decent run on the share price front, even though relatively defensive names have been out of fashion, as the market has latched onto cyclical stocks that could benefit from any improvement in UK or global economic momentum. Intriguingly, the food and drug retailer sector has overall done pretty poorly, with a 6.7% fall compared to a 2% rise in the FTSE All-Share to the end of February. That leaves the sector down among dead men, ranked 37th out of 39, with just oil and gas producers and fixed-line telecoms beneath it. This final graphic shows how food and drug retailers has ranked by total performance by week so far in 2017, with the first the best and 39th the worst. However, this isn't down to Sainsbury's or Morrisons, it's actually down to Tesco, an 8% fall this year, as analysts and investors have pondered whether its planned £3.7 billion cash and stock deal for Booker makes sense, or not. Sainsbury's still, by the way, has to prove that the purchase of Home Retail plc and Argos was the right thing to do as well, so keep looking to see if the deal yields the £160 million in cost and revenue synergies targeted within the first 3 years by Coop when the deal was first announced last March. Thank you for watching, and I look forward to seeing you next time.